What's going on, everybody? Welcome to a Capital Hungry Market Update and Trade Ideas webinar. We'll be doing a ton of market analysis and giving tons of value and information regarding current fundamentals, as well as some education regarding economics as well. So the few main things we're going to be talking about is, of course, the Fed pivot narrative, but breaking down the core concepts of that a lot of people don't understand, but you should be if you've been following along Capital Hungry webinars, educational content, and of course all of the macro webinars that we post on a monthly basis, of course for free on this YouTube. But we're going to be talking about US economic data to come, the main market driver and main information advantage that's been driving US dollar bias, gold bias, stock market bias on the US side, and having a major impact on market sentiment. And we're going to be breaking down expectations for a very important Bank of Japan rate decision that's in focus tonight, or for some of you people, tomorrow. Okay, so let's get right into it. We don't really have time to waste. Now, the main market narratives on US dollar, US equities, and gold since the Federal Reserve's monetary policy shift, where they started to raise interest rates and tighten financial conditions to, of course, combat and bring down inflation, was coined as the dollar domination phase, or the narrative of the Fed pivot phase. The Feds will slow down and they'll stop their rate hike. It's either been one or the other that's been holding the most weight, dependent on factors and events that support one or the other, which we will be breaking down now and going through it step by step, so you will have a full understanding of market impact and why US economic data has been doing what it's been doing. So no rush, we're going to be going through that first. Then we're going to go through the key events we have in focus in terms of economic data to come. It's supposed to be an E at the end there. And so forth. So, obviously, as the Federal Reserve exponentially increased money supply through the pandemic period to quote-unquote support the economy, but really just to pump the markets from crash points and create great opportunity for the rich, this led to extremely high US inflation, keeping interest rates low for an extended period of time, exponentially increasing money supply, pumping the markets with that money supply through asset purchase program or quantitative easing, and the whales and institutions riding that wave through the initial start of the pandemic period. This is where you saw the stock market go from a crash point to all-time highs and record-breaking new highs. Asset classes like crypto, with the example of Bitcoin, go to 60K. Gold go to $2,000 an ounce. Real estate in North America start to surge and go to record high prices as well, right? Their actions is what led to that very high inflation. But you can only keep that greed train going for so long before inflation starts to get out of hand and goes from high risk levels to hyperinflation levels, which there's tons of historical examples and even recent examples. You can look at Argentina is currently suffering, starting to enter hyperinflation territory in another hyperinflation crisis. But basically, the Feds had to jump in and take action for the high inflation that they created and start to tighten financial conditions through shifting their monetary policy and doing an active rate hike cycle, front-loading rate hikes in the most aggressive fashion seen throughout history, right? This is what brought the dollar domination phase, which held the most weight through primarily 8 months of 2022. You had the Feds doing an aggressive rate hike cycle never seen before in history, tapering any of their stimulus support to the economy, stopping of their asset purchase program, and tightening financial conditions, as their main goal right now wasn't to support the economy, wasn't to support asset classes like the stock market. It was to start combating and bringing down inflation that has become entrenched during this heavy money printed phase of the pandemic. Factors and events that supported this narrative on a weekly basis and on a monthly basis were various US economic data reports. The main one being inflation reports, your CPI reports, labor market data, and other US economic data such as PMI figures, factory orders, and so forth. As long as inflation was still high and continuing to rise, and as long as the US economy was stable enough to handle rate hikes, the Feds were going to continue that aggressive path, and the market was pricing in that front loading of Fed rate hikes in terms of the impact of more demand in the US dollar, less demand in risk assets such as the stock market, and gold being a lot more bearish as well. So when you're looking at the timeline phase of around 2022, with the example of the dollar domination narrative, (2022) timeline, Feds front load rate hikes. As long as we had Feds continuing to raise interest rates, as long as we had economic data supporting the continuous raise of interest rates, which was high CPI reports, labor market data still being strong, continued hawkish signals from the Feds via FOMC and speeches, strong overall US economic data through that phase, not having a deep recessionary scare yet at that moment, then we were going to continue to see dollar increase in value, which we coined as the dollar domination era. This is when EURUSD went to parity point 1-to-1 with the dollar and below. GBPUSD was not far from there. We saw USDCAD starting to hit higher price points on the higher time frame. We saw the stock market enter a bear market in a correction all the way to pre-pandemic price points. We saw crypto have a major correction. Real estate in North America start to correct as well. Why? Because the favorable investing conditions that the Fed set up during the start of the pandemic got completely reversed. At the start of the pandemic, on various asset classes, you had low prices because of the fundamental uncertainty and doubt and fear that led to the markets crashing. But those low prices create great investing opportunity for the rich, especially with the conditions that the Feds are going to be setting up. You had low interest rates, which led to a higher increase of investment activity as institutions are taking out more loans, investing it into the market, business-to-business loans are increasing and so forth, and overall economic activity is picking up. You have the whales riding this wave and the Feds also doing their asset purchase program, supporting these asset classes as well. That's why we saw so much greed in the markets during the start of the pandemic period for the institutions in Wales. But come a couple months into 2022, especially after the exact IMF meeting that occurred on the month of April 2022, as soon as majority of major central banks and the Feds leading the pack started to shift their monetary policy, completely reverse those favorable investing conditions. Now by this time period, 2022 April, you have gold at like $2,000 an ounce, just priced in. Russia and Ukraine tensions, all that stuff already happened. And now it just hit $2,000+ an ounce. You had stock market at all-time high price points. You had crypto at 60+K. You had real estate markets very bullish and at record high price points as well. Now instead of having low prices, you have very record high, all-time high prices or historical high prices. Instead of having low interest rates, you know a lot of aggressive rate hikes are coming, which decreases that investment and loan activity on an institutional, corporate, and business banking perspective. And of course, you don't have that Fed support of them pumping the markets and supporting these asset classes by buying them and putting it onto their balance sheet, right? Now, instead, they should be looking to offload their balance sheet and taper the stimulus support. So during that time, we had US dollar strength, stock market bears, and gold bears for pretty much an 8-month period from the start of 2022 and then into like November, end of 2022. But as we were approaching November 2022, we started to get the narrative shifting as we had factors and events that were supporting the hopes of a Fed pivot. Remember, over this timeline of 2022, we continue to check off these various events that supported dollar domination, that supported the aggressive rate hike cycle and the markets pricing that in. We kept having continuous high CPI reports, labor market still being solid, economic data still being solid, CPI still being high as well, and so forth, right? But as the Fed's front-loaded rate hikes in such aggressive fashion, faster than any time seen before in history, of course this is eventually going to start to do its job of trickling down inflation and leading to factors and events that support a Fed pivot narrative. Come November 2022, we started to get improving CPI reports, with CPI starting to show a decline. We started to get the labor market starting to soften a bit and weaken. We started to get a lack of aggressive Fed signals, a lack of aggressive hawkish Fed signals, and the Fed starting to talk about slowing down the rate hike path, looking at CPI month over month and see if it starts to have consecutive declines, and looking at recessionary scare data as well. And we started to get weaker US economic data. So from November 2022 to current time, this narrative is holding the most weight, which has been US dollar weakness, stock market bulls, and gold bulls. And we've even had recent economic data supporting that. The last inflation report still showed a decline, feeding into Fed pivot prayers. The last labor market data was mixed. It wasn't optimistic and solid. We haven't had very hawkish Fed signals. Jerome Powell's last speech was a neutral dud. He didn't bring any new events to the table. And US economic data has been getting weaker. We just saw Fed business index reporting come out at pandemic lows. Today, we saw factory orders and non-manufacturing PMI extremely weak a couple of weeks ago. PMI figures starting to soften as well. And overall economic activity in the US going down. There's two reasons that the markets are pricing in potential of a Fed pivot and stopping of the rate hike cycle. Reason one is that the Fed's job is being completed and we're seeing consistent trending decline of inflation going down. Or reason two is that the US economy is too weak to handle any more rate hikes and the Feds need to pivot and start supporting the market by providing stimulus again, lowering rates again, or stopping any further rate hikes. Because if the US economy, in terms of your monthly economic data, reporting your manufacturing sector, reporting your retail consumer activity, reporting your industrial activity and your import and export, if all of that is declining and the US economy is entering a deeper recession, then the economic state won't be stable enough to handle more rate hikes. But the market already starts pricing that in ahead of time as they're greedy motherfuckers, and the whole psychology of pricing in is about having an edge, right? That's why you have that famous Wall Street saying, buy the rumor, sell the news. Even though the Feds have not actually pivoted or stopped their rate hikes or inflation has hit their goals, just signals of inflation reports starting to decline or bad economic data is enough for the greedy stock market buyers to already start pricing in a pivot. Same thing with how the market was pricing in the front loading of rate hikes during the dollar domination phase, right? So this narrative, from a fundamental perspective, from the cartel of the currency, the central bank being the Federal Reserve for the US, potentially starting to pivot based on the events that we're having continuous declining CPI and labor market is starting to soften, and of course we're having weaker US economic data, that's leading to stock market bulls, gold bulls, and US dollar weakness, and that's what we're going to be still looking to play and holding the most weight on gold, dollar pairs like GU and EURUSD or USDCAD, and of course for anybody that trades SPY, US 30, Dow Jones, and so forth, right? Does that make sense to everybody? I've done multiple breakdowns on this. If you watch the higher time frame breakdown for free on YouTube from a month ago, the yearly review in 2023 expectations, and there's tons of breakdowns during the front loading of the Fed's rate hikes and during the dollar domination phase, right? So this is the main market narrative and what's been holding the most weight on dollar, US equities, gold, dollar pairs, and the majority of these asset classes, because the Fed is literally the leader, pretty much central, and you're looking at your global perspective of central banks. And obviously the US dollar is your world reserve currency and global business currency, right? So what we're looking at in terms of focus for this week is, are we having events that support the Fed pivot narrative, or are we having events that support the rate hike cycle narrative? So let's look at some data, for example. Remember, one of the main focus points has, of course, been the inflation figures for the US, right? And we can see for consecutive months now, when you're looking at inflation here, this is the 6-month trend. Inflation has been starting to trickle down as the front loading of rate hikes are starting to take action on the economy, and starting late summer of 2022, starting to have inflation peaked in decline since then, right? Here's the, you guys can see on the screen fully here, right? So this declining inflation showing that the front loading of Fed rate hikes is starting to do its job. Inflation is coming out of high risk territory. It's having consecutive months of decline. When you come back and look at the narrative, that supports the Fed pivot narrative, that the Feds will slow down their rate hikes. The markets have been pricing that in accordingly. And of course, that leads to US dollar weakness, stock market bulls, and gold bulls. For the example here, you can see that the last CPI report that showed signs of improvement in decline led to this liquidity grab on gold, and then continued upside in more demand in gold as an asset class, and the stock market still sitting at some of these higher time frame highs as dollar did the inverse and turned more bearish. Usually a lower inflation report shouldn't lead to gold bulls. In normal economic conditions where you don't have the central banking monetary policy holding so much weight after extensive stimulus or a very aggressive rate hike cycle, gold is usually seen as an inflation risk hedge. As inflation's high, gold goes up. But this is a unique situation where a lower inflation report led to gold bulls. It's because it's not the inflation report that the market is pricing in. It's the declining inflation report leading to a higher probability that the Feds will pivot and there'll be less aggressive rate hikes that's leading to gold bulls, dollar weakness, stock market bulls, even why crypto had a bounce. And everybody thinks crypto's going back to the moon again, right? But that's the same reason even crypto had a bounce. Okay? So we've had improving, declining CPI reports. The last US labor market data was mixed and not so optimistic. And we had worsening economic data, such as very bad non-manufacturing PMI figures, very bad factory orders, very bad Fed business index reporting, PMI starting to soften and weaken, and any chance that the Feds have come in, they haven't really brought any new hawkish events to the table. The last time Jerome Powell was on a panel just a week ago, he didn't really say anything about monetary policy. So now let's look at this narrative and what we have going on in terms of this week. If we want to continue, quick pop quiz now, right? Let's see who's paying attention, who's been learning from Capital Hungry, following along the webinars, taking your notes, and so forth. Tomorrow, in terms of economic data, for the US side anyways, right? We have producer price index reporting, which is your inflation from the producer side of things on the economic perspective, not the consumer side. And we have retail sales, right? Retail sales is expected to weaken, showing the US consumer is weakening. less consumer activity, and especially after the holiday phase, as a lot of the holiday spending starts late October, November, and just a bit early December, right? And the producer price index, obviously with producer inflation, is also expected to show a decline on the yearly macro perspective. What would we need to see with these data releases to continue dollar weakness, stock market bulls, and gold bulls, and continue the Fed pivot narrative? First, with PPI data, what would we need to see? Would we need to see producer side inflation increasing or decreasing to support the Fed pivot narrative? Nuno's correct. Sebi's correct. It's leak is correct. Correct. So we would need to see that producer side inflation is still starting to trickle down and decrease. Now, in my opinion, the decline in PPI doesn't even actually have to come out on the 6.8%. My main focus, by the way, everybody, is the year-over-year PPI. Year-over-year PPI, okay? I'm mainly looking at the year-over-year. And it's not going to hold as much weight as the CPI. The consumer price index is a lot more in focus from the central banking perspective and from the market pricing in perspective. But this is still going to either further supplement and add on to the Fed pivot narrative or take away from it. What we would want to see to continue the Fed pivot narrative, leading to gold bulls and continuing the gold bullish structure, GU bulls, EURUSD bulls, US 30 bulls, is declining PMI significantly below the prior. If it comes out at forecast or even lower, that's even better. And the closer you are to forecast or lower, the larger impact you'll have in terms of dollar weakness and gold upside, right? But we have to be very careful. We have two sets of economic reporting at the same time, and then some more important economic data only 45 minutes after into the new 4-hour candle period. What we need to see to have one-sided volatility and just to maintain this Fed pivot narrative is, remember, we need to see declining CPI reports, bad economic data from everything else. That supports US dollar weakness, stock market bulls, and gold bulls, and the hopes that the Feds will pivot and the Feds will slow down narrative, which has been holding the most weight for about roughly 3 months now in terms of market impact, ever since roughly November 2022. Everybody following along still? So I'm going to delete this off the screen right now because I have to write new stuff, but you guys can always rewatch this as you wish, take your notes, you know what I mean? So now, what I prefer as a manual retail trader, even if my prediction is wrong, I don't give a shit. I love one-sided volatility. So we have important US data tomorrow. To support or take away from Fed pivot narrative. Ideal one-sided volatility. Declining PPI data. Worsening retail sales. Worsening industrial production. This would be ideal. This would be impact, impulsive, dollar weakness, gold bulls, stock bulls, post liquidity grabs that happen with news. This would be ideal, right? Now, if my prediction is wrong and PPI is actually still increasing or high, retail sales isn't as bad as expected, industrial production is rebounding, that would still be one-sided volatility, but it would have the opposite impact here, right? if my prediction's wrong and we see that the producer price index is showing increases or the same as prior, unchanged at 7.4, retail sales is more optimistic than negative 0.8 and comes out at like negative 0.4, better than prior, and industrial production is improving, coming out of negative integer territory, this would still be one-sided volatility. It would still be data that's supporting the dollar domination and rate hike cycle narrative. And it would just lead to impulsive dollar upside, gold bears, and stock market bears. What I don't want is mixed data. I don't want to see a declining PPI, but then retail sales is good, but then industrial production is mixed. All that's going to do for us as manual retail traders is lead to very aggressive whipsaws. What you guys see on news periods where hourly candles end up like this, what I call a double dildo ended candle, where you just have a small body and you saw price on gold wick to the upside 100 pips, wick to the downside 200 pips, then just end up ranging for the rest of the day, giving no real clear buyer side control or sell side control, having a period of indecision because you have mixed economic data, right? So in my experience, I actually don't mind when my prediction is wrong, as long as it's completely wrong and we can still get one-sided volatility on the other side of the coin. Does that make sense to everybody? But what would be ideal situation tomorrow for continuing dollar weakness, potential Euro USD upside, gold bulls, stock market bulls would be declining CPI, worsening retail sales, worsening industrial production. In the example of gold, you might see a liquidity grab to the downside to collect orders, and then just some continuations up through NYSE and London session close hours, right? So let me give some examples here when we're just talking about that US data and the example of gold. Let's just say that we have 10 more minutes till the PPI data and gold is sitting at this active price point. Still very bullish in terms of structure. Buyers have still printed a high. We haven't showed any major signs of exhaustion at that high. We're just in what is called the secondary phase of market structure, which is a pullback phase. Having buyers exit positions, sellers jump in to provide that exit relief, pushing price down to more favorable buyer demand zones of interest to enter from better price points before continuing the trend. Secondary phases of market structure are either pullbacks and liquidity grab phases, or they are consolidation and accumulation of order phases and breakouts, right? You're not just always going to have the market impulsively moving up. It moves in waves. So gold is very bullish still. We're just in a secondary phase of market structure, a pullback wave. Let's just say tomorrow we're looking at this data and we get everything as we want, right? So the PPI year over year, it comes out at like 7.0, still showing a significant decline, showing that the producer side inflation is decreasing, feeding into the Fed pivot narrative, right? And then this one can be roughly at the same thing. Retail sales comes out bad, negative 1.3% or something, well below prior, well below forecast. Industrial production also just comes out right at forecast, right? This is pretty standard expectations with this data, not high expectations what I'm asking. My expectations, if we get this ideal data that's feeding into the Fed pivot narrative, is more than likely gold either into the data release, or as it gets released, you have liquidity grabs, will spike down to collect some orders, retesting around previous highs, stabilize on the lower time frame, then start to break above this corrective structure, and throughout that day, in the next daily period, continue to trend into the higher time frame highs. Right? That would be declining inflation data on the producer side from the prior on the yearly macro, Very bad other economic activity data with the retail sales and industrial production would lead to liquidity grabs, gold bulls, and this would be a very similar type of price formation of having liquidity grabs and upside, or just impulsive upside pullbacks and continuations on your dollar pairs like GBP USD and Euro USD, on US 30 stock market index, and on, of course, gold. For me to see gold bears, we would need economic data that supports the Fed rate hike cycle and dollar domination narrative. We would need to see high inflation data and optimistic other US economic data. We would need to see good retail sales, high PPI, and good industrial production. So in that example, if PPI is still high, this is actually in still the negative integer territory, but showing some signs of improvement. Industrial production's coming out of negative integer territory and showing some signs of improvement. This will lead to some deeper gold downside, having deeper pullbacks on the higher time frame, short-term bears in control, as dollar would be a little bit more bullish, having a pullback from lows, and stock market would be more bearish, as that goes and supports the Fed rate hike cycle narrative and dollar domination narrative, showing producer inflation is still high, retail sales is not as bad as expected, and consumer is still solid, and industrial production is not as bad as expected and still rebounding. Either way, I want one-sided data. I personally think we're still going to get declining PPI. I think we're going to get this. Right? What I don't want to see is mixed data. I don't want to see producer price index declining, but retail sales being optimistic and industrial production being neutral. All that's going to do in terms of the example of gold is lead to some ranging and indecision. Heavy whipsaws during the actual news, lower time frame ranging, no significant buyers or seller strength. Right? We also have to understand that market volume and volatility has been a bit lower and slower as we have the World Economic Forum event going on, that summit in Davos, right? Davos. So we have a ton of various central bankers, politicians, global economic leaders, all at this forum where you have to be watching reactive headlines outside of your data as well, where you could have a politician or central banker who holds some power say something significant about economics, monetary policy, or anything regarding financial markets and conditions. But anyways, that so far was just a breakdown of the Fed narrative that's been holding the most macro market weight, my expectations of data, and that how I want to continue potential gold buys, but what else to look out for. Something else that's been very important and that's in focus is we just went through the Fed pivot narrative. We just talked about declining inflation and bad US data feeding that narrative. That's the reason why dollar has been bearish, gold bullish, stock market bullish, your dollar pairs like GU and Euro USD bullish. We just talked about US PPI data and retail sales activity in focus and what to expect with that tomorrow. What's very, very important, and usually not as important, but it is this time, is Bank of Japan's rate decision, which is tentative tonight through Asian session hours. Can be roughly anywhere from 10 p.m. Eastern to like 3 a.m. Eastern. I've seen it sometimes as well. Okay? So the reason why Bank of Japan's monetary policy is in major focus is if you haven't been following along capital hungry headlines or updates, which I highly advise, follow the Twitter, it's free, follow the Telegram, follow the Instagram. Last week, we had a fundamental catalyst come into play that led to this extended GJ and yen pair weakness as Japanese yen picked up strength. The reason why Japanese yen picked up strength is the Bank of Japan's extremely loose monetary policy has been coming under heavy scrutiny for the negative side effects it's having on financial markets and, more importantly, the Japanese government bond market. Now, a lot of you can go into further detail to go and study bonds and how government bonds work. And obviously, that's how central banks inject money into economies through that transaction with governments of purchasing bonds, which are basically IOUs and debt that's never really going to get paid back. But that's a whole educational webinar for another day. What I'm talking about is Bank of Japan has had a monetary policy opposite to the majority of major central banks. To keep things short and sweet, Bank of Japan has had very weird economic conditions ever since their bubble pop and economic crisis collapse post 1980s, right? They've been dealing with a lack of inflation and dealing with a lack of economic activity as they depend really heavily on their global business and corporate profits and things of that nature, right? So as the Bank of Japan has been trying to accelerate inflation in their economy, they've had a very loose monetary policy. They've been doing unlimited bond buying. They've had interest rates in the negatives for an extended period of time. And what this done has completely corrupted and destroyed their bond market in essence, as the primary holder of Japanese government bonds is the Bank of Japan. They're like a 50% holder, which is not right. That's not balanced. That's not stable. That brings a lot of risks and concerns to the table. So there's been a lot of backlash, a lot of pressure, and a lot of scrutiny on the loose monetary policy of the Bank of Japan, and even some pressure for them to start tightening financial conditions. Now, this was last week, which made this Bank of Japan statement this week even more important. After this headline, leading into this Bank of Japan sentiment to come, implied volatility for the Japanese yen increased to 2020 pandemic levels. Right? This chart is Japanese yen implied volatility. Starting out, coming into obviously this new year, you can see a heavy increase in implied volatility, which is primarily in focus with the Bank of Japan's interest rate decision. The investors, smart money, market makers in Wales, they're primarily looking at one of two things. Either one, the Bank of Japan is going to keep everything the same, they're not going to start to tighten financial conditions, and they're going to continue to do their unlimited bond buying program going, continue to destroy their bond market and devalue the yen, and that's going to lead to impulsive yen weakness and GJ completely correcting this downside move, continuing bullish. Or two, they finally start to take some action, start to review the scrutiny they've been under and the risks that have come along of very loose monetary policy overstimulating their economy, and obviously the bond market imbalance with the Bank of Japan owning around 50% of the Japanese government bonds, and they're finally going to start to tighten financial conditions. If the Bank of Japan finally starts to change their loose monetary policy and tighten financial conditions, this will lead to very, very strong yen strength. So let's look at the yen here. The reason why the yen was so heavily devalued during 2021 and all of pretty much 2022 was a loose monetary policy by the Bank of Japan. Right? Through this entire time period, every single Bank of Japan monetary policy, they've stuck to this same script. But now, during last week, it came under heavy scrutiny due to the negative impacts it's having that led to this upside move. Whether we continue more bullish is going to be dependent if the Bank of Japan finally takes action to tighten financial conditions. I personally think that they're still going to stick to the same script. Bank of Japan's head Kuroda is close to retirement. I really think he gives no fucks anymore. He's going to continue to stick to the same script, continue their unlimited bond buying program, which they've still been doing. They might highlight some of the risks and just feed into the discussion that occurred from last week. But overall, I don't think we're going to see any changes until Kuroda gets out of the seat. But if I'm correct, and you just see that their monetary policy statement tonight, obviously they're not going to be doing any interest rate changes. A surprise rate hike would completely shake the markets and lead to massive yen strength and huge downside on your yen pairs. But there's more than likely not going to be a rate change. What you're going to be looking at is their actual monetary policy statement, whether you're looking at the headlines or you can go to the Bank of Japan website and get the full statement there right away, is are they still going to be continuing bond buying, stimulating the economy, keeping rates negative, and keeping everything loose and status quo? If that's the case and they don't care about those risks and that headline stated from last week, they're not going to be taking any hawkish action or tightening financial conditions. We might see a liquidity grab at this previous liquidity zone and price sensitivity area of interest, and then yen start to turn right back bearish again, fading out this pullback and corrective phase here. So in red, oh, you guys can't see it because the little magic keys. I'll put it up here. So the red price movement here, Bank of Japan keeps policy same. For us to see yen break above this price point of interest here and to see further strength on yen individually, especially with some of the implied volatility and a lot of the order flow waiting for this rate decision, we would need to see some discussions of tightening financial conditions. Either talking about slowing down or stopping their bond buying, coming out of negative rate territory, giving signals towards future rate hikes. That's going to lead to impulsive yen weakness and lead to an aggressive upside move to this next price sensitivity area here. Right? I also gave a nice breakdown on Twitter and the Telegram of this as well. But that's the main focus for yen pairs. I'm personally expecting that they're really going to keep everything status quo and that this was just a price setup, setting up better sell positions of interest for yen sellers to get in, as Bank of Japan Kuroda is going to keep everything the same, right? Bank of Japan's rate decision is always tentative, meaning it's dependent on when they choose to release it, and it could be between this time window of 10 p.m. Eastern to 3 a.m. Eastern. Personally, through my trading journey now of 6 years with focus on fundamentals over the last 4 to 5 years in extensive deep fashion, I've seen it range between those times. That's going to be the main focus point for GJ. Right? Will the Bank of Japan finally start to highlight some of the risks of their loose monetary policy? Start to talk about monetary tightening of financial conditions and raising of interest rates, which in the example of GJ, you'll see this. So let's just say GJ sitting at current price points of interest, right? Bank of Japan finally changes or signals policy shift. Slow down bond buying or stop it. Talks about rate hikes. Talks about easing risks that have incurred, right? Which would lead to yen strength, hawkish sentiment, yen strength, high volatility. You might see GJ do a heavy liquidity grab into this liquidity zone, generate some orders, then start to flip bearish, melt down to these lows, break this structure as well, and give you clean sells below structure after the sentiment is set in place. If they finally start to change their monetary policy, tighten financial conditions, or give signals towards that, and have more of a hawkish sentiment, right? Which is a possibility, as they've kept their loose monetary policy active for so long. It's having very negative impact on their bond market, as stated. It's heavily devalued the yen over like a 1.5 to 2 year period, right? And Japan has been seeing inflation starting to accelerate and increase. So if they wanted to start to shift into a hawkish sentiment, I wouldn't be surprised. If you do get those confirms, I'd confirm the liquidity grab, start to dive into the lower time frame after the post liquidity grab double top, and also break below structure sells, and you have pretty impulsive moves to previous lows. I wouldn't enter anything guessing games prior to the sentiment, hoping like, oh, is the sentiment coming out soon? You have to wait. Right? But if they keep everything the same, if they don't highlight the risks, if they don't talk about slowing down their bond buying, if they don't talk about stopping their bond buying, if they don't give any signals towards rate hikes, if they don't even talk about rate hikes or interest rates, if they do a copy and paste of the last monetary policy, then it's going to be the opposite impact. You probably have a liquidity grab to the downside, and then this entire move will get corrected. If you're holding a buy from 157 and you're going on holidays soon, I would close it with Bank of Japan sentiment overnight. There's such heavy implied. This is also last thing I want to say. Don't try to play guessing games before this specific Bank of Japan sentiment, because there's going to be, for us retail traders, there's going to be monstrous spread spikes. Huge. I'm talking 100 pip plus spread during the policy release when it comes out. There's going to be heavy lower time frame price spikes, heavy liquidity grabs. You're going to have to wait anyways for the news to be digested, market to simmer down, where for you as a retail trader, you can execute on it anyways. You know what I mean? The implied volatility I showed you is extremely high, waiting for this Bank of Japan sentiment. Even if our prediction is right, if you're a retard and you're trying to enter before or during as it comes out, you can still lose a lot of money with massive spread spikes, brokers freezing, huge order slippage, and your stop losses getting slipped, massive liquidity grabs, and so forth. Does that make sense to everybody? The implied volatility for this Bank of Japan statement is very high due to that headline from last week and the scrutiny that the Bank of Japan is under. Ever since this headline, you can see the yen volatility leading up to this Bank of Japan sentiment is extremely high. So there's going to be massive, massive spread spikes. Some people's brokers may freeze. Like, trust me. Why do you think I'm giving you such a big breakdown of the volatility, the headline from last week, the importance of this Bank of Japan sentiment? Usually Bank of Japan sentiments are pretty dead. They're pretty dud. You know what I mean? But this one is heavily in focus for a reason. That's why I'm focusing on it for all of you. Right? So anyways, with yen pairs, yes, you can still continue some scalps through like the Asian session, but I would primarily stay out and I would wait for this sentiment confirms. Does that make sense for everybody? Just for yen pairs for one night, be a little bit more patient. Is that fair enough? And this is also going to be the same impact whether it's NZD JPY, whether it's Euro JPY, whether it's AUD JPY. Just be patient. Let the Bank of Japan release their statement. Watch the huge spread spikes and huge liquidity grabs that happen. Wait for the confirms of the sentiment and say, all right, did they talk about rate hikes? Did they talk about tightening conditions? Is it the same policy statement as last time? Did they really bring anything new to the table? Okay, no. Japanese yen is weak. GJ broke above this high. Spread is starting to tighten again. The lower time frame's looking a lot cleaner. All right. I don't have to catch these huge liquidity grabs, but I can still catch this second half piece of the pie and still correct this downside move. Does that make sense, everybody? Same thing with the sells. If we do get hawkish confirms, them talking about rate hikes, them talking about tightening conditions, them talking about the risks and issues that have been occurred with their loose monetary policy, you don't have to mess with the liquidity grab. You don't have to mess with the spread spikes. Once you start breaking structure and your spread starts to tighten again, lower time frame price actions looking cleaner, you can grab a huge piece of the pie and continuation moves with expectations to break these lows. Does that make sense to everybody? So my GJ analysis, yen pair analysis is completely dependent on the very high volatility, important, in focus Bank of Japan sentiment. All right. Now, that was just mainly GJ analysis. Obviously, if you want to scalp it, that's up to you. But just keep that in mind. Okay, now, other than that, what else do we have going on overnight? So, of course, Bank of Japan's monetary policy, right? That's mainly in focus for Jap. And because Bank of Japan's monetary policy is in heavy focus, it's going to have impacts on gold, equities as well, even as it impacts market sentiment and algorithmic order flow through the markets as a whole, right? So keep that in mind as well, where you might be in a gold trade in Asian, and if you get spiked out or see heavy spread spikes or liquidity grabs, you know Bank of Japan's monetary policy just got released. So it's going to be impacting more than yen pairs when it gets released, in my opinion, due to the heavy implied volatility and focus on it, all right? But that's in focus. Also, for everybody who doesn't know, through this entire week, the World Economic Forum is going on. You have prime ministers, financial directors, central bankers, economic leaders all together here at this World Economic Forum. So you're going to have to be looking at your reactive headlines, which the Capital Hungry News Twitter is a great source if you're not in the private channel, getting access to, you know what I mean? Terminal headlines that we have before mainstream news up to the second. Use the Capital Hungry News Twitter instead, because that's also why market volume and volatility has been lower to start the week. If you guys haven't noticed, is the markets are waiting for some of this key US data, waiting for some of these Bank of Japan, waiting for the central bank, Bank of Japan policy, and we have a bit markets a bit more on edge with the World Economic Forum currently active. Right? That's throughout the whole week, like just actively going on. You can see headlines anytime. All right? In terms of economic events, we have some Japan economic data at 6:50 p.m. Eastern, but nothing else besides Bank of Japan is in focus for the yen. Overnight, more than likely after the Bank of Japan sentiment during pre-London hours, we do have core CPI and CPI figures for the UK, which is starting to potentially show bits of declining and that the Bank of England's rate hikes are doing work. But GJ's main impact is going to be Bank of Japan sentiment. This will probably hold some more weight on GBPUSD playing the continued dollar weakness bias. I'm expecting relatively on forecast figures, not going to be holding that much market weight in my opinion, still keeping some demand in GBP when you're looking at it against a weak dollar. On GJ, it's all Bank of Japan tonight, right? And then, of course, we already broke down the data that we have during the North American trading session, which is your producer price index, retail sales, industrial production, and so forth, and whether that's going to feed into the Fed pivot narrative or the rate hike cycle dollar domination narrative. I'm hoping for improving declining PPI, feeding into Fed pivot narrative, bad retail sales and consumer activity, bad industrial production, continued gold buys, dollar weakness bias from this data tomorrow. But I already gave you guys full breakdowns of what to expect for that. In terms of trade ideas on the intraday perspective on gold, it's currently in this corrective structure, but still having higher time frame bullish structure respected. Just like any of these phases, as highs are printed and you have buyers taking profit, you enter a short-term pullback phase depending on volume. Once we can validate a support also leading to a shift out of the corrective structure, we can easily jump back into the bulls and ride that wave back to the same highs, playing the trend back to 1930s. But we may have some ranging up until Bank of Japan sentiment and the US data in focus tomorrow. So very simple trade ideas here for me would be that if gold breaks below these previous highs and current lows, I'd be expecting deeper pullbacks in liquidity grabs to be coming into roughly, I had a zone here from last week economic data. What the hell? This is just prior to the data tomorrow morning and prior to BOJ. Then obviously during New York, it's going to be dependent on the US data and the breakdowns and full fundamentals I gave you during this entire webinar. But just talking about trade ideas in terms of the next sessions to come, if we break below 1902 and 1897, I'd be expecting short-term extensions of this pullback structure and sell plays to retest better buy zones of interest before still continuing the higher time frame bullish bias. Otherwise, safer buys would be if we don't break these current lows, right? We validate the double bottom, we break above key level 1912 and break above the corrective structure, showing us coming out of the corrective phase. I'd also be looking for buys back above, just playing with the continuation of trend from 1912 and above this rejection at 1918. Keep in mind, if we have some ranging and slowdown up until BOJ and of course US data in focus, don't be surprised. GJ trade ideas were given and are 100% dependent on, of course, Bank of Japan sentiment and that breakdown I gave you. So take your notes and review that. In terms of GBPUSD, dollar weakness sentiment is still holding the most weight as we have the Fed pivot narrative as the active catalyst the market's pricing in. From improved inflation reports and weakening US economic data, dollars continuously printing these lower lows, creating stronger intraday bearish structure. Even if we get a pullback to 103.6 or break these current lows, dollar is still very bearish. Of course, what's going to further support this bearish bias is declining producer price index and worsening retail sales data tomorrow. Otherwise, if we get the opposite, that's more than likely just going to be the catalyst to lead to a dollar pullback before still fading it out and having sellers come into play. So on GBPUSD, we're still respecting bullish structure. We had nice accumulation of order flow and liquidity grabs with CPI. Nice accumulation of order flow from 2165 key level Intraday highs being printed and revisited. Still having dollar weakness bias. It's very common. You can see pullbacks to these levels multiple times on the intraday perspectives. So you can never take those scenarios and potential buy zones out of your trade opportunities because it still give you great trades to play. And I'd still be looking for GU buys as long as dollar remains weak. We don't have a major change in inflation overall. We still continue this bullish structure and bullish price action. I'd only look for sells below 2-1. Fed pivot narrative holding the most weight. Euro USD, we had a pullback in rejection from previous intraday highs, but you can see with Euro USD, whether it trends bullish or trends bearish, that's very, very common that you may not break previous highs right away, and you can either have consolidations or pullbacks to generate more order flow before having your breakouts. Even having us retest this accumulation zone and roughly previous highs at 1.07 would still be very bullish here on Euro USD intraday and higher time frame structure that's been forming and holding over the last 3 months as the Fed pivot narrative has been holding the most weight. Dollar still weaker as your world reserve currency. We still have bullish market structure, a pullback that's just occurring and some exhaustion from new intraday highs. No shift in structure, no fear, uncertainty, or doubt that already hasn't been priced in from the Eurozone. Pullbacks to 1.073, daily lower wick, and then come back above 7.9. Breaks above 8.7 would still be a Euro USD bullish bias. Keep in mind the World Economic Forum reactive headlines. And of course, US dollar, US economic data tomorrow that's going to be impacting US dollar. Just from current price points, unless we get very high PPI data or very improved optimistic retail sales, we don't have any reason to be buying into the dollar or selling GU or Euro USD. Or a technical perspective, I need to be breaking structure, which on the intraday is below 1.0654 price point. USDCAD is more just ranging on the intraday time frames. I don't really see any significant trade ideas here unless we get a technical range break, which in my opinion is more than likely going to come at the New York session dependent on data. Safe sells below 336 and 1.31 if we continue the Fed pivot narrative. Only any pullback buys with intraday 30-minute or hourly candle closures above this range, signaling higher potential of deeper pullback on the intraday time frames. Now, the US 30 stock market is showing some signs of exhaustion at this previous price sensitivity area of around 34,400, but dollar still remains flat. Volatility index is still relatively bearish. We still have this accumulation of buy side liquidity in this area, and we're still having this intraday bearish, bullish sequence of events being respected. It's very common that we could get deeper pullback phases where even if we were to retest 33,200 liquidity zone again, it would still be bullish in just generating order flow, and of course above 34.4. If we don't get dollar domination confirms of high inflation reports or optimistic data supporting the Fed rate hike cycle, or more Fed rate hike confirms from the Feds themselves, then we're going to see stock market buyers just ranging at these highs or still trying to squeeze out as much as they can, right? But anyways, everybody, I don't want to make this webinar too long as it gets difficult for people to watch, and I've been talking for more than an hour now. I give away more information for free than some of you guys are paying for mentors who giving you guys 5-minute webinars and stuff. Right? We've been playing the Fed pivot narrative since November, bro. but it's probably just Luca again. You just came in, I saw us talking about it at the end. Trust me, bro, I'm way smarter than you, I'm better than you, I'm faster than you, more efficient, more knowledgeable, more experienced, better looking, funnier, more confident, all around a better human being. And never fucking forget that. But I'm going to save and upload this. You guys can always rewatch this as you wish. And I'll see all of you later.